The year is 2025. The world stands on the precipice of monumental change, with technology and politics intertwining in ways never seen before. Former President Trump, back in the Oval Office, has dropped a bombshell. His latest announcement has sent shockwaves through the global economy. New tariffs, broader and steeper than ever before, are now in effect. Global markets are reeling, with stock exchanges plummeting and financial analysts scrambling to make sense of the chaos. Uncertainty hangs heavy in the air. The storm clouds of economic instability gather, casting long shadows over businesses and households alike. But amidst the chaos, a different kind of market watches with keen interest: the world of cryptocurrency. This digital frontier, often seen as a refuge from traditional financial systems, is buzzing with activity. This is not the first time crypto has faced economic headwinds. The resilience of digital currencies has been tested time and again. Bitcoin, the OG cryptocurrency, was born from the ashes of the 2008 financial crisis. Its creation was a direct response to the failures of traditional banking systems. Its very existence is a testament to the desire for a decentralized, tamper-proof financial system. Blockchain technology, the backbone of Bitcoin, promises transparency and security. Could these new tariffs be the catalyst for another crypto surge? History has shown that economic turmoil often drives interest in alternative assets. The crypto community, known for its resilience and adaptability, is abuzz with speculation. Forums and chat rooms are filled with discussions about the potential impacts of these new tariffs. Will this be a boon or a bust for Bitcoin? Investors are closely monitoring price charts and market trends, trying to predict the next big move. Will stablecoins pegged to fiat currencies become the safe haven investors seek? These digital assets offer stability in a volatile market. And what about the burgeoning DeFi space, promising a financial revolution? Decentralized finance platforms are gaining traction, offering innovative solutions outside traditional banking. The answers to these questions, and the actions taken in the coming months, could reshape the financial landscape as we know it. The potential for a financial revolution is on the horizon. One thing is certain: the stage is set for a seismic shift. The tremors of change are already being felt, and the aftershocks could be profound. The question is, are you ready? As the world braces for impact, individuals and businesses must prepare for the unknown. The future is uncertain, but with preparation and adaptability, we can navigate the storm. Bitcoin mining, the energy-intensive process that secures the network and generates new coins, is heavily reliant on specialized hardware. This hardware, known as ASICs, or Application-Specific Integrated Circuits, is designed specifically for the purpose of mining Bitcoin. These machines are far more efficient than general-purpose computers, but they come with a significant cost. Much of this hardware is manufactured overseas in countries like China, where production costs are lower. The global supply chain for these components is complex and involves multiple stages of manufacturing and assembly. With Trump's new tariffs driving up import costs, the profitability of Bitcoin mining is under scrutiny. These tariffs, which are part of a broader trade war, have increased the cost of importing mining hardware into the United States, making it more expensive for miners to upgrade or replace their equipment. Miners, the lifeblood of the Bitcoin network, operate on razor-thin margins. The cost of electricity, hardware, and cooling systems all add up, leaving little room for profit. Any increase in costs can have a significant impact on their bottom line. Increased costs could force some miners to shut down, potentially impacting the network's hash rate, a measure of its processing power and security. If enough miners are forced to cease operations, the overall hash rate of the Bitcoin network could decline. A significant drop in hash rate could undermine confidence in Bitcoin, at least in the short term. The hash rate is a key indicator of the network's health and security. A lower hash rate means the network is more vulnerable to attacks. However, the crypto space is known for its ingenuity. Developers and miners are constantly looking for new ways to overcome challenges and improve the efficiency of the network. Already, some miners are exploring alternative solutions. These include using renewable energy sources such as solar or wind power to reduce electricity costs and minimize their environmental impact. Relocation to countries with lower energy costs and more favorable regulations is on the table. Countries like Iceland and Canada, with their abundant renewable energy resources and cooler climates, are becoming attractive destinations for mining operations. Others are investing in more energy-efficient mining equipment, seeking to offset the impact of tariffs. Advances in technology are making it possible to mine Bitcoin more efficiently, using less power and generating less heat. The coming months will be crucial for Bitcoin mining. Miners will need to adapt to the new economic realities and find ways to maintain their profitability in the face of rising costs. Will the industry adapt and innovate its way through these challenges, or will the tariffs deal a blow to the network's security and stability? The outcome will depend on the ability of miners to innovate and find new ways to reduce costs. The answer could have significant implications for the future of Bitcoin. If miners can successfully navigate these challenges, the network will emerge stronger and more resilient. If not, the future of Bitcoin could be at risk. As global markets brace for volatility, investors often seek refuge in stable assets. Traditional safe havens like gold and the US dollar may see renewed interest. But in the crypto world, a new contender has emerged: stablecoins. Pegged to stable assets like the US dollar or a basket of currencies, stablecoins offer the benefits of cryptocurrency: speed, transparency, and low transaction fees, without the price volatility. In times of economic uncertainty, this stability can be extremely attractive. Financial analysts predict that Trump's tariffs could trigger a flight to safety, potentially benefiting stablecoins. As investors seek to protect their capital from market swings, the stability and accessibility of stablecoins could make them an increasingly popular choice. However, it's important to remember that not all stablecoins are created equal. Their stability depends on the underlying asset and the mechanisms used to maintain the peg. Investors would be wise to carefully research and understand the risks associated with different stablecoins before making any decisions. Section 4. DeFi, a safe harbor in the tariff tempest. Decentralized finance, or DeFi, is building a parallel financial system on the blockchain. Free from intermediaries and traditional financial institutions, DeFi offers a range of services like lending, borrowing, and trading, often with greater transparency and lower fees. As Trump's tariffs threaten to disrupt traditional financial systems, DeFi could emerge as a viable alternative. Its decentralized nature makes it resilient to geopolitical tensions and trade wars. Moreover, DeFi platforms often operate with stablecoins, further mitigating the impact of market volatility. The current climate of uncertainty could accelerate the adoption of DeFi solutions. Businesses and individuals seeking to bypass traditional financial channels and hedge against economic instability may find DeFi to be an attractive alternative. However, it's crucial to remember that DeFi is still in its early stages of development. The technology is evolving rapidly, and risks remain. Smart contract vulnerabilities, regulatory uncertainty, and the complexity of some platforms are factors that users need to be aware of. Section 5. Opportunity in the eye of the tariff storm. Strategies for the savvy investor. In this section, we will delve into how savvy investors can navigate the turbulent waters of the current financial landscape and uncover hidden opportunities amidst the chaos. Volatility, while often feared, can also create opportunities for savvy investors. When markets are unpredictable, those who are well prepared and informed can find unique chances to profit. Understanding market trends and being able to react quickly is crucial in these times. Trump's tariffs have injected uncertainty into the markets, but they've also created a breeding ground for potential profits. The key is to stay informed about policy changes and understand their potential impacts on different sectors. By doing so, investors can position themselves to take advantage of market shifts. Here are some strategies for investors to consider. These strategies are designed to help you navigate the current market conditions and make informed decisions that could lead to profitable outcomes. Diversification. As always, diversification is key. By spreading your investments across various asset classes, you can reduce the risk of significant losses. This approach ensures that if one sector underperforms, others may compensate. Spreading your portfolio across different asset classes, including cryptocurrencies, can help mitigate risk. Cryptocurrencies, while volatile, offer high potential returns and can be a valuable part of a diversified portfolio. Stablecoin investments. Consider investing in stablecoins as a hedge against market volatility. Stablecoins are designed to maintain a stable value, making them a safer option during turbulent times. Look for reputable projects with strong track records and transparent reserve management. This ensures that the stablecoins you invest in are backed by real assets and are less likely to experience sudden value drops. DeFi exploration. Explore the world of DeFi and consider investing in promising projects. Decentralized finance, or DeFi, offers innovative financial products and services that operate without traditional intermediaries, potentially offering higher returns. However, do your research and understand the risks involved before making any commitments. DeFi projects can be highly speculative, and it's essential to know the project's fundamentals and the team behind it. Active trading. The volatile market conditions could create profitable trading opportunities for experienced traders. Active trading involves buying and selling securities based on short-term movements to capitalize on market fluctuations. However, proceed with caution and use risk management strategies. Tools like stop-loss orders and position sizing can help protect your investments from significant losses. It's important to remember that investing in cryptocurrency carries inherent risks. The market is highly volatile and prices can change rapidly. Always stay informed about the latest developments and regulatory changes. Never invest more than you can afford to lose, and always do your own research before making any investment decisions. By staying informed and cautious, you can navigate the complexities of the market and make sound investment choices.